have you ever noticed something that feels almost ridiculous? After you understand rate hikes and cuts, and QE and QT, you can build a simple framework. Central banks have two toolkits. One is the price toolkit, hikes and cuts, which decides whether borrowing is expensive or cheap. The other is the quantity toolkit, QE and QT, which decides whether there is more money or less money moving through the system. We often treat hiking as tightening and cutting as easing, but when you combine both toolkits, you get 4 different policy postures. The first is hikes plus QT. This is the strongest tightening mix because borrowing becomes more expensive and liquidity is pulled out at the same time. The signal is clear: fight inflation and cool an overheated economy, and this was the Fed's typical mix from 2022 to 2023. The second is cuts plus QE. This is the strongest easing mix because borrowing becomes cheaper and liquidity is injected into the system. The signal is also clear: backstop the economy during a crisis, and this is what the Fed used in 2008 and again in 2020. The third is cuts plus QT. This mix can confuse markets because the central bank is easing the price of money while tightening the quantity of money. Unless communication is extremely clear, this posture is difficult to sustain because it sends signals in opposite directions. If you connect the pieces, you can see that the central bank is not only changing the amount of liquidity in the system, it is also moving the pricing benchmark for long-term assets. When that benchmark is lower, risk assets can lift more easily, and when it resets higher, valuations have to adjust. The fourth is hikes plus QE. This looks the most contradictory, but it has happened. It is usually not about broad stimulus, it is about repairing a specific market function. For example, when the repo market was stressed in 2019, the Fed used liquidity injections at certain points to keep funding markets functioning. The goal was to fix the plumbing so trading could continue normally.